The Federal Reserve deciding to cut interest rates for the first time in 4 years, and it's a supersized one. The Federal Reserve voting to cut its interest rate by 50 basis points. The stock market's lifting higher on this announcement that just happened minutes ago. Markets had anticipated a 50 basis point cut, but most economists were weighing more closely to the 25 basis point cut. So we have a lot to dig into now that we have this very first interest rate cut in 4 years' time, as the Fed decides that its interest rate hike campaign to bring down inflation has worked, and now they need to be balancing inflation risks with employment risks a little bit more evenly. I'm going to bring in Chris Constantinos. He's the managing partner and chief investment strategist of Riverfront Investment Group. Chris, we talked about this before. This is a history-making day. The Fed has been holding its rate at levels that have not been seen in more than 2 decades for over a year now. Now we're going below 5% for the first time since May 2023. Were you surprised to see the 50 basis point cut?
First of all, thanks for having me on, Simone. Was I surprised? I'll admit I was a touch surprised. I know that the Fed funds futures markets were pricing in, kind of a higher probability of 50 than 25. But in my heart, I think I was holding out hope for a 25 basis point cut, simply because I don't think the Fed necessarily needs to cut this much. My feeling is that the U.S. economy writ large is actually in pretty solid shape. I understand the manufacturing side of the economy is struggling and has been, frankly, for much of the past year. But the services side, which is, in my opinion, a bigger and more impactful part of the economy now, actually remains pretty expansionary. And a lot of the data we're tracking doesn't suggest we're at the precipice of a recession. So I think they could have done 25 and just talked dovish in the Q&A. But nonetheless, 50, it seems like the market likes it. I think this is sort of a Goldilocks type of situation for the market, because we've got markets near all-time highs, or maybe at this point, while you and I are talking, maybe they've eclipsed it. I don't know. But at the same time, you've got, unemployment well below 5%. You've got corporate cash flow at all-time highs. You've got a GDP now that's tracking somewhere around 3% for Q3. This is sort of like, it's kind of Goldilocks, right? That you're getting rate cuts in the midst of strong earnings and strong economic data.
Rate cuts in the midst of strong data, and at the same time, a jumbo-sized rate cut. We are more typically accustomed to seeing this more measured 25 basis point cut. Was there anything leading up to this? Because there's a lot that's changed during the Fed's quiet period. For our listeners, we are going to hear from Fed Chair Jerome Powell right at 2:30 Eastern time. He's very punctual, always takes the podium on time. So make sure to stay with us right here on this live stream, because we're going to get to that speech. But I want to talk more about this decision. We went into a quiet period where I think the majority of people thought that we were going to be cutting by 25 basis points. And in fact, the markets were betting that it was going to be a 25 basis point cut. What's happened in the last couple of days that all of a sudden that narrative switched and markets went really bullish toward that 50 basis point cut, which is in turn what they got from the Fed?
Yeah, to be honest with you, I don't think it was data driving that switch in probabilities, because if you look at it over the last week, look at the data that we've gotten, right? We've gotten some jobs data that was inconclusive. We've gotten retail sales, which are actually stronger than expected, kind of showing that the U.S. consumer is pretty resilient. We've gotten industrial production, which actually surprised to the upside. So I don't think it was necessarily a change in data. I think the reason the market probably switched its probabilities is that it watched some of the folks in the press who have probably the closest ear into the Fed sort of, act a little bit less perfunctory around a 25 basis point cut and some of the things they were writing, and that may have changed some market participants' probabilities that way. But I don't believe that it had anything dramatically to do with any data that's been released in the last 4 or 5 days.
To your point, the Fed doesn't like to surprise people. And when we hear things in the press, it's usually done in a deliberate way, right? They're trying to send messages out there so people have an expectation of what is going on. I was with you. I was in the 25 basis point camp. I just thought that based off of some of the comments, I knew that it was time to cut, obviously. Fed Chair Jerome Powell made that explicitly clear. We were not questioning whether today was going to have a rate cut. But given how slow the Fed has moved, it is a little bit surprising to see that 50 basis point cut. The only thing I could think in my head that would argue for 50 basis points today is that they're not going to meet again until after the election. So that is a couple of months of time that's going to pass where maybe this gives them a little bit of a buffer if some of the data releases that come out between now and then are more sour. That would, stabilize people's expectations a little bit more, knowing that they did make this jumbo cut right here in September.
Yeah, Simone, I think that's a good point. If you think about Jerome Powell and his tenure so far at the Fed, I think the thing he doesn't want to be remembered as is, the 1970s are sort of his nightmare scenario, right? Because under part of his term, we let the inflation genie get out of the bottle. Of course, that was, in my opinion, mostly related to, COVID, supply chain disruptions, et cetera. But nonetheless, the genie of inflation got out of the bottle during his tenure, and he's a very astute studier of history, and he doesn't want to be Arthur Burns. He doesn't want to be the Fed from the 1970s that required, Paul Volcker to come in and do some pretty dramatic actions that hurt a lot of Americans in the short term to get that back under control. So I think this is a Fed that probably wants to err on the side of accommodation versus potentially running the risk of getting behind the curve. If I'm extrapolating, that's probably what led to this decision, in my opinion.
Yeah, and they wrote in their release today as they announced this 50 basis point cut. Again, I'll lay it out. The first cut in 4 years, and the first time we've been below 5% for the Fed's target rate since May 2023. So we are entering less restrictive territory, going on that downhill climb. But the Fed did say in their release that the economic outlook right now is uncertain. Obviously, this is something that is weighing on them after they've seen unemployment change in the last couple of months. And in fact, they've released some new projections. They do this every few months as to what they think is going to happen with unemployment and the different rates. And one of the things that I noticed and pulled out of it was that they do anticipate that the unemployment rate is going to be a bit higher than they initially thought. They're setting the unemployment rate at 4.4% for this year and for next. So that's higher than we're at right now at 4.2%. And then in 2026, 4.3%. Are we just going to be living in a higher unemployment rate, period? Do they think that's what is going to help keep inflation down?
I think so. And not to get overly wonky for a second, but one of the things
get wonky. We love to get wonky here.
Okay, okay, all right, here we go. You might regret that statement. But one of the things that economists look at, and I'm sure the Fed in their training looks at, is a concept called the beverage curve, where you have these proxies for employment, supply, and demand, and the proxies are typically things like the unemployment rate is sort of a proxy for demand, and supply, and job openings is a proxy for supply, right? And you're trying to meet that supply demand curve. And what they're probably seeing is that we're now in that point where the beverage curve, where every bit of loss in job openings probably translates directly to the unemployment rate rising. Kind of the slack, if you will, is sort of gone now. We're also seeing it in wage data, by the way. And this is one of the reasons that I think the inflation genie is, thankfully, for the most part, stuffed back in the bottle, is because the propensity to raise wages, some of the survey-based data we track, suggests that there's much less wage pressure out there, which can sometimes, it's good for inflation, for bringing inflation down, but it also indicates a job market that, whose complexion may be turning. And, you put all that together and you're the Fed and you say, look, we don't want to get behind on this because, if the job market is changing significantly and every little bit of loss in job openings or job creation is going to directly affect the bottom line. And, in the Fed's term, the bottom line would be the unemployment rate. Then they need to get out ahead of it, because remember, they really have two mandates. They have price stability and they have maintaining full employment. So they would rather be ahead of the curve on maintaining full employment than get behind and start playing this confidence game of, that's what really recessions can be, is that sometimes they're a confidence game or a lack of confidence game. So you don't want to get behind on that if you're the Fed.
Yeah, I wholeheartedly agree with that. I think that it can be a bit of a self-fulfilling prophecy. If you lack confidence in what the economy is doing and what it's going to be doing, we could trigger our own recession. And that's not something you want to do. So keeping people's hopes high, keeping investors, and people running corporations thinking that this is a good economy, this is an economy worth investing in. And speaking of investing in things, this is going to make it easier to borrow money as we've entered this new rate cut era. I'm looking at the stock market right now as it continues fresh. We're really flirting with the S&P's record high right now. It's up about 0.5%. It spiked a little bit higher on the news of this rate cut, and I'm trying to hover over to see what that would have been. But certainly at those record highs, given that now that we're in this rate cut cycle, what does this mean for the markets?
Yeah. So, if you take a you take a step back, I mentioned it earlier, this is potentially a kind of a Goldilocks scenario for equities. And generally speaking, it's not just a US phenomenon because you have now the majority of central banks around the world in an easing cycle. So you have a bit of a coordinated easing cycle that's happening throughout Europe. It's happening obviously in America, it's happening in UK and the Eurozone, et cetera. Most places really besides, say, Brazil or Japan. So this is generally speaking a pretty good backdrop for tactical investing. The number one rule of tactical investing, in our opinion, is don't fight the Fed, right? Our three tactical rules for trying to decide what to do with stocks over the next, call it 3 to 6 months. Don't fight the Fed, don't fight the trend, beware the crowded extremes. Well, you're fighting the Fed if you want to be too bearish, clearly, because we're in an easing cycle now. The trend for markets, both globally and particularly in the United States, is higher. It's up. The 200-day, moving average is definitely higher, and the crowd may be, at a little bit of an optimistic extreme. But since September tends to be a pretty volatile month and has been volatile earlier this month, sentiment is a bit elevated, but not dramatically so. Maybe after this, it will be, but nonetheless, that's still a decent backdrop for tactical investing. So I think generally speaking, it's a good thing for markets. Now, what you and I will need to decide here over the next 10 or 20 minutes is, as the Fed engages in the Q&A, what's the body language for Jerome Powell and the Fed? And the market is likely to trade a lot off of that. We also know that the latter half of September tends to be the worst 2-week period in markets for the whole year. That's a historical anomaly that I've written about. I think this is a pretty good tactical backdrop for investing, but it might get a little weirder before you get the all clear towards the end of the year. We also have a U.S. election to contend with.
Yeah, of course, just throwing another thing in there. And I think I've mentioned this before, but the Fed won't meet again until the 2 days following the US election. So here's their one rate cut. And obviously there were, some conversations about whether they should take action ahead of the election. Former President Trump saying that he didn't think the Fed should act at all ahead of the election, saying any action would be considered political. But as we've covered this throughout the entire year, waiting for this rate cut cycle to begin, it's just been clear that the data is there to cut. This doesn't have to do with politics. And in fact, the Fed really tries very, very hard to remain as apolitical as they possibly can and stay out of that conversation. As we are 7 minutes away from Fed Chair Jerome Powell taking that podium, what do you anticipate he should say now? We had discussed what you thought he should do had he cut 25 basis points. So now that they've gone the full 50, what do you want him to come out and say? How do you want him to behave? What do you think is going to be the best case scenario?
Yeah, that's a great question. So I'm sort of in the speak softly and carry a big stick camp. And I think he just brandished a pretty big stick with a 50 basis point cut in an economy that's growing 3%. With an unemployment rate under 5%. So I think in the presser, I think he should probably speak softly. I think he should probably try to strike a pretty balanced tone, because on the other side of this, what the Fed doesn't want to see, I don't think, is runaway markets to the upside. Because obviously they probably prefer that to the opposite of that. But nonetheless, I don't think that they want to create bubbles here either, because that makes things more difficult for them down the road, whether you're talking about a bubble in real estate or a bubble in the wealth effect in equities. So I think the prudent thing to do here would be, to present a very balanced view. Obviously, they did have one dissenter. I know that Powell likes a consensus Fed, and there was one person on the council who, recommended 25 basis points rather than 50. So I think striking a little bit more balanced tone and not overtly dovish tone during the Q&A, I think would be appropriate for such an outsized move.
Yeah, it was either go the more measured cut and act dovish in the press conference, or go the jumbo cut and kind of temper expectations. Speaking of tempering
Correct.
expectations, the market got their way this round with that 50 basis point cut, but their path over rate cuts over the next year appears pretty aggressive from the people that I talk to. So the markets are pricing in that in less than 12 months, they'd be getting the Fed funds rate down to under 3%. That would be 250 basis points in less than 12 months. Seems aggressive. The Fed's projections do not support that. They see their Fed funds rate going to 3.4% by the end of 2025. So certainly more measured on their front. What do you make of these expectations that this will be a slide downhill when it comes to cutting rates?
Well, kind of going back to my earlier point that I think the U.S. economy is more resilient than a lot of people give it credit for. Therefore, I side more with the Fed on this one than I do with the current market pricing. I think that is a pretty aggressive level of interest rate reduction into an economy that I think 6 months from now will still be afloat. And look, I hope I'm right about that. If I'm wrong, then of course this means that the U.S. economy is much weaker than we currently expect, and we'll have to course correct in terms of our market strategy and portfolio action. But nonetheless, I think we've seen this movie before. If you recall, coming out of COVID, or even during COVID, I should say, the U.S. economy was really resilient. It took the initial shock of the government-led shutdown, and businesses right-sized themselves very quickly. This is part of the flexibility and dynamism of the U.S. economy and of corporate America. And within a year, corporate cash flow was back above where it was pre-pandemic. By the way, that didn't happen in Europe. That didn't happen in Asia. This is a uniquely American sort of economic exceptionalism, if you will, is what I've termed it. And so therefore, I think this is why people are constantly underestimating the resiliency of the U.S. economy. So I just don't see that number of rate cuts happening over the next year or so, or year and 3 months, as really being consistent with an economy that I think is going to end up outperforming a lot of expectations, just like it has, frankly, for much of the past 4 years.
Yeah, and to that point, there's been a long period of time in recent history where we've had really low level interest rates that have allowed this economic boon. It started after the Great Recession, where interest rates were kept low for a very long time. They had really kind of just started hiking the rate, and then COVID hits, right? And so all of a sudden we're in another low interest environment. Do you think that the age of this low interest rate environment is over? I mean, the Fed needs room to be able to react. And I think, to your point, this economic exceptionalism has come in part from a Fed that has had a bit tighter strings on the economy to be able to say, hey, let's help this out. If we're softening or we're weakening, we've got tools in our tool belt. Do you see them keeping rates higher than we would have, than we're used to seeing, I would say, in the last couple decades?
I do, as a matter of fact, and this is actually something I've written extensively about this year, and it's in the context of real interest rates. So in other words, interest rates adjusted for the rate of inflation. That period that you talked about after the great financial crisis, call it 2008 to 2022, 2023, that was a very abnormal time in U.S. financial history, because that was a time when when interest rates adjusted for the rate of inflation were actually below zero consistently. That is not the way it's supposed to work. And it creates a tremendous amount of inflexibilities and bubbles, for lack of a better term. It creates asset bubbles. Frankly, it's really, really bad for the average American. It's bad for the American who's trying to be prudent and save, because it penalizes savers. It accentuates or creates an incentive for excessive risk taking. And this is not the type of environment, I think, that if you're a policymaker, that you want the nation to be in. So what we've done here is we've moved back ever since, call it about a year ago. We've moved back to a world where inflation-adjusted interest rates are positive. And while that required an adjustment in 2022, and the markets was a big adjustment for that, and it was a bit painful, nonetheless, it got us to a better place, which is a more normalized kind of interest rate environment. And this is what I think we should all be on this show, and in America, we should all be hoping for this. We should be hoping for a more normalized rate where things aren't at the zero bound, because that just creates, I think, some levels of moral hazard around risk taking that I don't think we want to incentivize.
Yeah, and we're looking at the podium shot now. Jerome Powell expected to speak any moment. So I'm going to go ahead and tag you out here, Chris Constantinos from Riverfront Investment Group. We really appreciate your thoughts on this today.